Financial Accounting Chapter 10. Introduction. The term inventory refers to the raw materials used in production and the goods produced that are available for sale. A company's inventory represents one of the most important assets it has, because inventory turnover represents one of the primary sources of revenue generation and subsequent earnings for the company's shareholders. There are three types of inventories, including raw materials, work in progress, and finished goods. It is categorized as a current asset on a company's balance sheet. Counting inventory. In a business that does not have accurate inventory records, it is necessary to periodically conduct a complete count of the inventory, known as a physical count. This is usually done at the end of a month, quarter, or year to coincide with the end of a reporting period. As the following procedure shows, it takes a great deal of effort to complete an accurate physical inventory count. Hence, companies tend to limit the number of counts completed per year. Valuation of inventory at historical cost. A historical cost is a measure of value used in accounting in which the value of an asset on the balance sheet is recorded at its original cost when acquired by the company. The historical cost method is used for fixed assets in the United States under generally accepted accounting principles GAAP. Inventory flow. The inventory cost flow assumption states that the cost of an inventory item changes from when it is acquired or built and when it is sold. Because of this cost differential, management needs a formal system for assigning costs to inventory as they transition to sellable goods. Other cost method. When an investing entity invests and the investment has the following two criteria, the investor accounts for the investment using the cost method. The investor has no substantial influence over the investee, generally considered to be an investment of 20% or less of the shares of the investee. The investment has no easily determinable fair value. Valuation of inventory using output values. Inventories should be valued at lower cost and net realizable value. Following are the steps for valuation of inventories. A. Determine the cost of inventories. B. Determine the net realizable value of inventories. C. On comparison between the cost and net realizable value, the lower of the two is considered. The inventory value. A comparison can be made item by item or by the group of items. Refer to case studies given at the end of the article. Let's discuss the important items of inventory valuation in detail. A. Cost of inventories. B. Cost of purchase. C. Cost of conversion. D. Other cost. Following are the categories of conversion cost. I. Direct cost. E. Fixed overhead cost. 3. Variable overhead cost. Practice. Accounting practice is the process and activity of recording the day-to-day financial operations of a business entity. Accounting practice is necessary to produce the legally required annual financial statements of a company. There are different accounting methods that companies can choose to use, and there are principles that companies must abide by. Generally accepted accounting principles, GAAP, refer to a common set of accounting principles, standards, and procedures issued by the Financial Accounting Standards Board, FASB. Public companies in the United States must follow GAAP when their accountants compile their financial statements. Current replacement cost. Replacement cost refers to the amount of money a business must currently spend to replace an essential asset like a real estate property, investment security, alien, or another item with one of the same or higher value. Sometimes referred to as a placement value, a replacement cost may fluctuate depending on factors such as the market value of components used to reconstruct or repurchase the asset and the expenses involved in preparing assets for use. Insurance companies routinely use replacement costs to determine the value of an insured item. Replacement costs are likewise ritually used by accountants who rely on depreciation to expense the cost of an asset over its useful life. The practice of calculating a replacement cost is known as placement valuation. Construction contracts. IAS 11 construction contracts provides requirements on allocating contract revenue and contract costs to accounting periods in which construction work is performed. Contract. Revenues and expenses are recognized by reference to the completion stage of contract activity, where the outcome of the construction contract can be estimated reliably. Otherwise, revenue is recognized only to the extent of recoverable contract costs incurred. Construction contracts in practice. A contract specifically negotiated for the construction of an asset or a combination of assets. Examples of construction contracts include those negotiated for constructing highways, buildings, oil rigs, industrial units, pipelines, airlines, and other similar assets. IAS 11 deals with accounting construction contracts from the perspective of the contractors who undertake such projects on behalf of their clients. Self-constructed assets for an entity use are accounted for following IAS 16 and are not within the scope of IAS 11 construction contracts.